I think it's like 10 lines of code maybe, and it's
Wow. Wow.
yeah, my portfolio is based on like a 4-layer diversification. Now I'm trading 25 systems in my private portfolio.
So basically, you're 95% confident your future results will mirror your past results because you have so many samples.
Everyone, watching the FOMC meetings, everyone want to watch Powell, but it's a tiny change in the market is going to cost me.
And you just falling off a cliff.
Yeah, and this is a thing that people kind of disregard a lot.
I'm just curious, what's the average duration of your trade? Hey everybody, it's Boris Schlossberg. Welcome to the Trading Battle, where we talk to some of the best traders in the world, explore their techniques, find out about their edges, and help you become a better trader in the end. Today, we have a very, very special guest. I have Oscar Olsson today from Square2.io. Welcome to the show, Oscar. Nice to have you.
Thank you very much.
Originally, you were an engineer, or you certainly were like in the mathematical sciences when you started your career, and that background has led him much more towards algorithmic trading, towards robotic trading, rather than discretionary trading, which a lot of traders do. So let's start with that. Let's just talk a little bit about how did you get started in the markets, how your own personal background may have influenced your journey here, and tell us a little bit about yourself.
Sure. Like you mentioned, my background is physics. So I was I went to university for physics and been working as an engineer for about 15 years after that.
Right.
So a lot of the stuff I do in my daily work or at school, all the mathematical, the numerical analysis, number theory stuff, programming, all that I could apply to trading pretty easily. All the skills that I had in my toolbox could be easily applied to the finance market. I guess started like everyone else. I was a buy and hold.
Let me stop you there. Why do you think physics, which is the study of mechanics of natural phenomena, applies to the market? Which, if everybody always says that the market is completely non-predictable, precisely because human behavior changes so much. What made you think that there was some connection there?
I think my focus in physics was optics. So photonics, optics, lasers, and that kind of stuff.
Okay.
So if you know a little bit about light is made up of waves, right? Or particles, depending on who you ask, but let's say waves in this case. So there's a thing called a Fourier transform that we use in wave physics. Mm-hmm. They use, it's like equation used to deconstruct like a compound wave into its constituents. So you can look at a wave and you make the Fourier transform, and the result is you get all these little components, all these waves that sum together creates this compound waveform.
Right.
And I look at the market as kind of like a compound wave. So I try to take that Fourier transform and break it down to its constituents. I look at those little frequencies. So I look at the bigger waveform, but also zoom in, and I can try to figure out the pattern of that waveform.
Interesting. Anybody who's ever looked at a chart of any price action, but certainly the U.S. stock market indices, can see wave price action literally every minute of every day of the others. We're watching if you're watching the background here of the S&P right now on the chart, and you can see the wave patterns just in the closing minutes of the trade. So there's no doubt that wave is the primary property of price movement. That it never moves in a straight 45-degree line. It never drops. There are points where it will drop like a stone, but eventually it's always settles into sort of a wave-like motion. It's true. So you think that particular property is why the Fourier function and generally the application of physics has helped you become a better analyst of price action?
I think so. And also the stuff, not only price action, but even when you come to the analysis of just my algos, like Monte Carlo techniques and parameter sensitivity, all that kind of stuff that I've applied to bigger data. A data set is a data set, regardless if it's from an experiment that I do in the lab and I get some data out, or if I look at the markets and I do an algo. So I'm used to handling big data sets and use different techniques to analyze the data, find patterns, and that's what I do with the financial markets now.
Then, when you say big data sets, one of the things that I think, almost every trader who likes to backtest their ideas, if it works in the last 5 days, that's good enough for them. It's kind of a short-term pattern. What do you consider to be a reasonable, time frame for a data set? for you in order to have any kind of statistical confidence on the prediction?
Yeah, it depends on the time frame I'm looking at and also the asset. But if you want to look at, let's say, NASDAQ 1 hour or something like that, that's one of the main ones I use.
Yeah.
I used to look at 2,000 bars. So if I have an hour, I look at 200,000 rather hours.
Okay, 2,000 bars is a pretty short time frame. So 200,000 bars.
200,000, correct. 200,000.
200,000 is 200,000 hours. What does that translate to? It's like, let's say 20 hours in a day. It's basically 1,000 days, kind of, roughly.
Something like that.
Roughly for the non-mathematical of us. Close enough for government work, as we say.
Yeah.
So, okay. I mean, that's a pretty reasonable. I think, honestly, actually, I don't know if I'm actually curious in your statistical studies. I think when you go further, you actually get into noise. And the reason why is because markets change. Really, I think there's just sort of like I don't know, there's not a natural organic cycle to the market, but there's certainly a real degradation of behavior persistence after 2 or 3 years of some kind of price action. I mean, markets may trend over long periods of time. Sometimes they can trend over decades, but within those decades, there's 2 or 3 years where price action is completely different from the prior 2-3 years. And the further you go, the less you know, I think, in some ways. Do you agree with that? Sometimes,
I definitely agree with that. And I can, even with my system I'm running now, I can tell that a lot of them, if I just choose to look at, let's say, what happened right before COVID, because I think, in my view, my algos or the data just changed right after that. More retail traders came in, more, what should I say? There's more momentum, more volatility, more, for sure.
Absolutely.
So looking at, like, say 2019 and forward, I think that the stock market is behaving radically different from, let's say, like 2010 to 2019.
Yeah. So, well, there's that. I mean, there's so many components that I think people always forget. There is, yes, a whole new class of actors.
Yeah.
There is far greater dominance by high frequency traders and algorithmic traders, period, which basically means that computers which execute at a factor 1,000 faster than any human being ever could are driving price action both up and down. But there's also really different macro environment. I mean, in the 2010s to the 2020s, we had no interest rates. Interest rates were zero for not a day, not a week, not a month, not a year, for a decade. There literally was no yield. And that created such an incredibly boring, damped market price action, because people forget that, interest rate is the sort of a risk-free rate of return. And the bigger, the fatter it is, the greater the volatility of every other asset, because you're always being judged of, like, I can make 5% here doing nothing, or I got to jump in. But when there's nothing, when there is no alternative, and, your only alternative is equities, you're not going to have nearly as much volatility because there's nowhere to go. There's nowhere to go. There's nowhere to jump.
No, you're right. I think, especially this environment we've got with everyone, watching the FOMC meetings, everyone want to watch Powell try to decipher every word he says.
Right.
So I can have an algo that just acts on the data on the FOMC meetings, just because how volatile the markets are right then.
That's really interesting, because nothing, I think, destroys trader equity faster than FOMC meetings. It's really one of the hardest days to trade. I host a big show called Trader Fest, and one of the guests that I have here, who's an old, line pit trader, his advice is always to trade the smallest on Fed days, because it's just inevitable. As you said, there's massive volatility that comes up. So, I'm just curious, without you obviously revealing all your secrets, what's the is it a momentum indicator? What works on Fed day algorithmically that you found?
So on Fed day, I narrow my window of time or trading window to right when he starts to speak.
Okay.
So I trade within like an hour, 45 minutes, something like that.
Right. So it's the presser and the QA, which is always the most important part of it, right?
especially, yeah. And in the QA, it's funny because you can see it going, up, down, up, down, up, down, really kind of these quick, rapid movements. But I'm using a lot of volume, and I'm also looking at Bollinger Bands. So if it breaks the band and you have a lot of volume, I might ride that band for a little bit and take a profit. I'm not trading much. I'm happy if I get 1 or 2 trades in during those days.
I'm curious because volume, I think, is a very interesting discussion. And I'm a volume skeptic.
Okay.
And there are volume believers, just like,
Sure.
I think, there's the Vax skeptics and Vax believers. Sure. And I guess a lot of this may be perspective, but I'm just curious from your perspective, are you a volume believer in a sense? Do you use the large volume is confirmatory for you, or actually a reversal signal? What do you view as large volume? Is it a confirmatory signal for you?
I gotta admit, I don't use volume that much. I think I use volume in 2 systems I've got, and one is the FOMC. So in the case of the FOMC, I really think it confirms the signals.
So big green candle against a very, very large volume. In the futures market, there's a tool called Bookmap. I don't know if you're familiar with, and that's sort of like, a common. What it does is it shows the size of the volume as the size of the bubble. I mean, you see this massive, big bubble. Yep. Basically, you be a buyer of a big green bubble in FOMC day because you believe there'll be continuity in price. That volume is forecasting further gains ahead.
Correct.
Okay. And obviously, that's not the only input that goes into your analysis, but you're basically just for that particular day within that particular parameter. That's a parameter you're paying attention to.
Yeah, correct. So volume and then the Bollinger Bands. That's what I'm looking at for FM.
So with the Bollinger Bands, is it a matter of you looking for the price to walk along the Bollinger Band?
Correct. Yeah.
Well, and we can take a look at charts in a bit, but for those of you who may be wondering what that is, so Bollinger Bands are essentially a way to statistically show the price is trending, because trend by its very definition means you're moving away from the average. You are creating something, aberrational. Because typically, if you think about it, price is just simply flat. It's when it starts to trend, then it moves away from the average. And the idea of walking the band is basically the concept of extreme moves along the upper end of the Bollinger Band, which suggests more and more buying or more intense momentum on that price. So you're looking at what on 1 hour charts, 1 minute charts. How are you examining that price action during the FOMC?
So for the FOMC meetings during that short time frame, I'm usually looking at 5 minutes.
5 minutes, and if you see momentum, you're gonna go for it. Obviously, you probably it's a relatively small trade. Like, is it indicator driven? Do you enter on a sort of indicator value, exit on indicator value, or is it price driven? Is it a percentage?
It's indicator value. So I got it's conditional entry and exit.
So there's a lot of different ways that you could enter a trade. The most common basic way is people just do a money target. I want to make $100 per trade. That's my target. A little more sophisticated ways, I'm going to make a percentage trade. I'm looking for 10 basis points, 1/10 to 1%, or maybe 1% move, so on and so forth. Another way that a lot of people will trade, especially from the old days, is they'll trade level to level. Let's say NASDAQ goes from 21,000 to 21,100. So round numbers, that's a natural exit point. And then, of course, when you're trading algorithmically, a lot of people, I noticed that a lot of algorithmic traders like to use indicator, which is a sort of a second derivative of price. There's price levels, and then the indicator is a derivative of price as an entry, and an indicator as a exit. Isn't that getting you in late and getting you out late in a way? Do you feel the tax of the mathematical tax of the fact that this isn't the primary value, it's a derivative value, so therefore it's lacking by its very definition, or you don't care?
It's a really good question. For entries, I've always done conditional. I've always entered on indicator. Okay. For exits, I've used all kinds of methods. I've done take profits. I've done, like you said, levels. I've done percentages, and I've done conversion. So it really depends on what I'm doing. If I'm looking at a trend following system, for example,
right,
I don't want to miss that. If we got like a really strong trend going on, I don't want to miss out on profit just because I've reached my target. So that way, I might go out on like a SMA or EMA cross, for example.
Okay.
But if I got something like a mean reversal, or some other type of system like a momentum or a short, I might put in a take profit in that one.
Yeah. Interesting. So mean reversion, take the profit quickly. Continuity trade, which is trend trade, let it run until it proves that you're right, until it exhausts itself.
Yeah.
Don't try to guess the top, but definitely if you're selling the top, make sure you take the money back quickly. That's I think that's probably, I mean, certainly my attitude, it's certainly my technique. You're trading mean reversion. It's like holding an ice cube in your hand. It's going to melt.
Yeah.
You better get rid of it.
Yeah.
Where, if you're trading trend, I don't know what the right analogy for that is, but it's it's like you can milk it for much longer than you think you can. It's interesting. Is there any other when you trend exit strategies that you've tested that you found to be interesting besides moving average crossovers? What other interesting possibilities do you like to change? Like, what other techniques you've said, this is interesting, this is something valuable, I want to use it in my arsenal?
I'll be using a little bit of like RSI divergence. If you look at the price against RSI, for example, if I'm looking at daily, if we got a daily trend following system, I might look when you see that divergence coming in and it looks weaker and weaker. That might also be an indication that the trend is kind of slowing down. So that's something that I've used, and I use it in one system right now.
Okay. Now, again, RSI divergence. This is another one of those things that can be taken both ways. I'm sure you've seen this, but I'm curious how you've dealt with this. So price makes fresh highs, right? Sure. Makes fresh highs, and RSI does not. It's just a classic RSI divergence technique. Yeah. There's other variants of this thing, but this is really the most classic.
Sure.
However, that's a property almost always. When we talk about waves, so the first wave is always the most powerful as far as price action goes, because it's just mathematically calculating the biggest rises. Then on a relative, remember, RSI is a relative strength index. So to go from 0 to 100 is powerful. To go from 100 to 200, you're still going 100 points, but it's relative from 100 to 200. It's on a relative basis, it's actually a slower rise, and RSI is going to rise slower. But it doesn't mean that price is tapping out. I guess my point is, a lot of times price pauses but doesn't fall, and RSI will give you divergence, and it's a false indicator. So sometimes it's true indicator, sometimes it's a false indicator. How do you combat that aspect of the of the trade?
To try to filter out false signals, kind of.
Right, or try not. Your whole idea is I want to stay in trend.
Sure.
And I don't want to get faked out by a false RSI signal. Any thoughts on that?
Yeah, I mean, you're completely right. It doesn't, just RSI divergence alone doesn't mean that you're trying to stop. So I've usually used an RSI divergence in combination with other indicators as well.
Right.
I might look at, again, volume bands and look at, is it kind of getting weaker and dipping below that middle, or is it even touching that lower point of the volume band?
Yeah.
I might also look at EMA in there, crossover.
Right.
So I use a combination of indicators. I'm not looking at the RSI divergence alone.
Okay, interesting. Yeah, because you look at sort of more harder evidence of a top than just simply momentum.
Yeah. So it's like I get redundant a bit with my signals, but I'd rather be overconfident than exit too early, because there could be a lot of pips to be that you leave on the table, so to speak.
No, for sure. Speaking of that, by the way, what's the average duration of your trades? Like, what is do you trade on a daily chart? Do you trade on the? I mean, I just said you trade on the hourly chart for Nasdaq. Is there general approach that you take to your duration, and how long do those trades usually last?
It's hard to say. I've got systems ranging from 5 minutes all the way up to weekly. So it's all over. 5 minutes and hourly, they are usually intraday. If I'm looking at 4-hour daily, there might be holding 5 to 7 days. Weekly, obviously longer. Maybe two weeks at the most, probably for weekly.
How many systems do you trade now?
So right now I'm trading 25 systems in my private portfolio.
25 systems. Are they all trading in one single account, or are they trading in 25 separate accounts?
No, one single account.
I'm just curious, why do you make that choice versus 25 separate accounts? And I want to ask you, a couple of sub questions regarding that. Sure. If you're trading in one single account, you're always vulnerable to like sort of one system just going crazy, right?
Yeah.
Algo just, you may change the size, or algo gets, the stops get dropped and stuff like that, and that exposes all of the equity to the mistake of one algo. Whereas if you segregate by account, it just blows out that one account out of 25, 24 state hold. Is there any reason? Just because you're like, I'm too lazy to have 25 accounts?
No, I have traded several accounts before, but I came to the conclusion that with the approach I have is I'm looking rather for the perfect portfolio rather than the perfect algorithm.
I see.
So I'm not looking to develop these algorithms that look fantastic. They're, usually overfit if they look fantastic. But I'm looking, every time I develop a new algorithm, I'm looking, how will it fit into my system? Right. And I'm looking to what's the correlation? What's the correlation of drawdowns? What's the PMI? So PMI is point-wise mutual information, which means that how often do they overlap each other in trades? So I can use my equity as efficient as possible.
So are those 25, essentially, so you have 25 different algorithms. You have a way to measure how many of those algorithms are essentially the same algorithm, or like sort of the same trade, in if not in principle, but in practice? Is that kind of how you...
Yeah. That's kind of how I do it. And I've got in my library of algos, I have probably around 50. So I kind of rebalance it and change according to what market regime we have, so that it will fit into the portfolio.
Interesting. And obviously you have safeguards, for like, is every single of those 25 strategies equally weighted, or do you like favor, like having a favorite child? Do you like, oh, this algo is doing better, so I'm going to give it a higher weighting?
Not really. I kind of weight them according to risk and volatility. So depending on what kind of market we have, I kind of re-weight them. If we have a trending market, that's
how do you determine risk and volatility? Because those are, a priori variables. In other words, they change in real time. So like, what's your measure of volatility, and how far back do you go to do this? And then how do you determine risk? Is it just because like some strategies have really, really wide entry and exit parameters, and others are, like you said, 5 minute is obviously going to have much tighter parameters than somebody that trades on a daily? Is that how you segregate that?
Yeah, that's kind of how I do it. And especially volatility, VIX usually, but a lot of it is, I wouldn't say gut feeling, but a lot of it's just looking at the charts and determining, like, are we in a bear trend right now, or in a bull trend? What is the market? What does it look like? Is it choppy, or is it not? So it's a lot of manual studying of the charts. I don't have any like one file or something.
So now the truth comes out. So now the truth really comes out. So this is where it gets interesting. So ultimately, what's fascinating is that you obviously have a set of very clean, crisp algorithms, and we'll talk about how you test them and how you everything. And I'm sure they've been battle tested quite a lot, both in demo and probably small size, and then larger size, before you deploy them. But ultimately, they are essentially execution agents, and you constantly have to monitor the regime of the market to determine which execution agents you want to deploy. You're sort of like the general, and you have to decide which part of the armed forces are going to, work best in this particular battle against the market.
Yeah, that's a good analogy, and that's how I do it. So I know some people refer to us as swing trading your own algos. But I don't know that. But
when people talk about that, when they're saying swing trading your own algos, what they're actually referring to is applying technical analysis to the actual equity curve of the performance of the algo. So let's say if the algo just keeps rising like a positive trend, you just stay with that. But then if it starts to peak and starts to decline, you're like, the trend in the algo has ended. I'm either going to minimize, allocation to it. So in other words, if it's 1% allocation, now it's going to be 0.5% and maybe even 0.25%. So it doesn't do much damage until it picks back up and for argument's sake, the equity crosses 20 period SMA as a signal until it starts making fresh new highs. And then I'll come back to it. Is that something that you do, or you do something a little more sophisticated? But I'm just curious. Is that what you're talking about?
I do that among other things. So a lot of it is really simple stuff. So if we're in a bear market, for example, and if I see that, EMA or SMA 50 is under SMA 200, I might overweight my short algos to follow the short trend. If we're in a bull trend, like we've been, for a couple of weeks now, or since the election, I might overweight my trend algos or my momentum algos, just to take that macro kind of environment in to see what happened and to kind of optimize them.
Have you looked at your results when you overweight versus if you had back tested this and just left everything alone? Have you done that, and have you compared the results? I'm just curious.
Yeah. I've kind of like done a portfolio optimization over time. So I've been going back testing, let's say from right before 2019, 2018, something like that, and kind of theoreticize like what would I do in this situation.
Okay.
First, what would the performance be if I had this combination of algos? So I have a little Python script that I wrote that has access to all of my algos in my library, and which then optimizes the perfect portfolio and tells me like, okay, this is the date you switch this one out for that one. This is the date you switch this one out for that one. And then if you look further, you can see what happened that date. Okay, we went into a downtrend, and what signifies the downtrend? You can look at, simple stuff, SMA stuff. And then, so it gives me kind of like an output. This is how you should act, pretty much.
So does the algo simply like just sort of a very, very simple decision tree is 50 drops below 200, the algo says, we're likely now in a downtrend. Therefore, the conditional behavior should be 75% of your algos now should be short weighted versus 50-50 or whatever the ratio is. And this is how it would have performed. And then with the price. So my question is, this is that's an apps. It's always works great when we have continuity of equity, continuity of stuff.
Yeah.
It's beautiful. But we all know that, if only we had continuity, life would be so simple. We all have algos that make money in continuity. The thing that kills us is a market regime that essentially fakes you out. It looks like, 50 drops below 200, stays there for 4 or 5 days. You're like, let's get short. And then it just comes right back up to the 200. And we're sort of, now you're shorting a rising market. You're always one step behind, and chop just bleeds you up, bleeds you down. I'm sure we've all been there, because nobody has figured out the El Dorado. Nobody has figured out the magic formula. But what do you do to help you minimize the damage of constant, brutal chop, which basically makes you be on the wrong side of the market all the time?
Yeah, I always look to hedge. So even though I have like a portfolio optimizer, it doesn't really look for the most gain possible.
Yeah.
I usually look for like the most stable performance. I'm on hedge in those kind of periods.
How would you hedge in a chop environment? What would you do? Do you have like a mean reversion algo that you would?
Yeah. I often talk about my portfolios based on like a 4-layer diversification. So first I look at markets. I want to have as many markets in there as possible. So I might want to have, NASDAQ, DAX, the bigger ones, maybe an Asian market. And I also want to have oil and gold, some Forex in there. And then step number 2 is type of time frames. So I want to have a good mix of 5 minutes, 15 minutes, 1 hour, 4 hours, daily, weekly.
Right.
And number 3 in that 4-layer is the type of systems. I got shorts, mean reversals, trend, momentum. I even got some intra-weekly stuff like Turnaround Tuesday, the classic one. And then if you want to look at the 4th layer, I might even throw in different types of indicators that the system is based off. So I might have one that's based off of RSI, one that's maybe super trend one, maybe VWAP, things like that. So try to have a good mix as possible.
Interesting.
And I think that kind of hedges it from those choppy markets.
So you hedge it both sort of by behavior, calendar behavior, by indicator choice, and by the actual architecture structure of the EA. It's interesting.
Yeah.
Okay. Well, one of the things that you're sort of really well known for is your very robust ability to test your ideas. I wonder if you could walk us through a little bit about some of your, testing approaches. We're looking now at MetaTrader 5, right, which is where you do a lot of your programming and testing. Maybe you can walk me through here. I'd love to see what you're doing.
Sure. Yeah. So this program, or EA, that's what the algo is called in MT5. It's called Expert Advice.
Right.
So there's a simple system, but simple, I don't mean stupid. I just mean really clean, few triggers. I think it's like 10 lines of code, maybe, real easy. And it's
Wow.
Yeah.
10 lines of code. That is Spartan as Spartan it can be.
That's my favorite type. I mean, I want as little code as possible. I'd almost rather underfit than overfit.
Really? That's so interesting. That is really interesting because almost everybody writes 2,000 lines of code. So 10 lines of code is just to sort of understand. It's literally by if this happens. Kind of. It's incredible.
That's kind of my philosophy, and I'd rather have many of those systems averaging each other out than having a complicated one, because I did a lot of complicated stuff in the beginning. I just had to spend a lot of time on it. I had to re-optimize it every month, and it was just like time consuming. And most of the people I talk to in the space just moving.
I forgot the technical term for the statistical term. It's called degrees of constraint. I think that's what it is.
Yeah, correct.
It's a fancy term for saying, if I have 10 conditions before I actually make an action, all those 10 conditions are, an action in and of itself. And therefore, instead of helping me, they very often hurt me, because one, they never line up, perfectly in a sequence.
Yeah.
And by them not lining up perfectly in a sequence, you're missing opportunities that are clean, entries. And also, a lot of times you are taking opportunities that are not clean entries because each one of those conditions is not as primal as it should be. So that's sort of like you try to minimize the degrees of constraint, and let the portfolio kind of become the meta degree of constraint through the interesting. Okay.
Yeah.
So this is an RSI breakout strategy. It's a 65-85, basically, as you showed me, right? 1 hour chart, NASDAQ. The blue arrows take the trade. The red arrows exit the trade. And anything else you want to tell me about this?
No, that's about it. You can see here on the chart down here, you have the classic, you have the 30, and the 70 right here on the dotted lines. And then with the red lines, you have the 65 and 85. So what I wanted to do is I want to enter the trade when momentum is building up, but I'm not really at the top yet. So I enter at 65 and I exit at 85 if we hit that. Otherwise, I have a static take profit at 50 for this one.
Static take profit. How would it be? 50 what? 50 RSI?
No, 50 points.
Oh, 50 points. I'm sorry. Yeah. So the 50 points of this. Now, where's the stop? Like if if it's a fake out move like this, I see there's one on the chart where it goes 65 and then kind of dips back down. It just doesn't really have any extension. What do you do then?
It stops at 52. So I got a 1-1 risk return on this one.
Oh, so there's a hard stop at 50 points. On the thing. How long do these trades last typically? So 1 hour chart. What's the average duration of these trades?
So one trade, you're usually in and out within 1 bar of the trade.
1 bar, which is an hourly bar.
Yeah, so under an hour. And you see here, obviously, it takes a lot of, you're in an uptrend, and it takes a lot of continuing because the condition is still true.
Right. So to understand this, it's buying But does it keep buying? Like it looks like quite a lot of times in this particular sequence, it's above the 65. It never dips below. So is your attitude is like if you buy if it's above 65, keep profit, still above 65, keep buying, keep buying, keep buying.
Yeah.
Until so if the next bar is above 65, I'm a buyer. If the next bar is above 65, I'm a buyer. Just that kind of very simple, but really very effective move in an uptrend. So really interesting.
And funny you said uptrend because this one I put in like you can. I haven't done it in this specific one, but you can put in like 50, 200 crossover filter as well to make sure that when SMA 50 is over 200, you get even more cleaner results. But it kind of impacts the Monte Carlo. And I look at that a lot. So I chose not to have it in this case.
Right. Let's talk about Monte Carlo. What is Monte Carlo? What is the Monte Carlo analysis? What does it involve? And why are you sort of such a big proponent of it? Aside from the fact that you like to go to Vegas, but aside from the fact that there used to be a casino in Vegas called Monte Carlo before they took it down. But tell us.
No, so Monte Carlo is essentially you randomize all of the different outcomes. So the order of outcome, let's say you have a list of my trades. Right. And I've taken 5,000 trades in a certain time period. And then I want to randomize that to see that, because you never know what the future graph might look like. So you might have a strong trend of, many winning trades, and then you might have a trend of many losing trades. So anyway,
just to walk you through so that our listeners can really understand and our viewers can really understand this. There's 5,000 discrete trades. What randomizing it doesn't just mean that, the last trade becomes the first trade.
No.
You're going to randomize it where there are going to be literally 1,000 different variations of how imagine it's like a deck of cards, right? Each trade is a card in a deck of cards, and you're going to shuffle it 1,000 different times so that, trade 993 can become trade 32. Trade 55 becomes trade 775. And it's the new sequence when, trade 32 and then it's followed by trade 775. It's the new sequence that produces a very different looking equity curve, because obviously, you could have maybe 7 losers in a row instead of in the history it was 7 winners in a row. That's the outcome, the actual physical outcome of a Monte Carlo simulation, and you have 1,000 of those different outcomes that you're looking at. Is that something?
I usually do 5 or 10,000 when I do Monte Carlo.
Okay, that's fine. I just want to make sure I was explaining it correctly to most people who are just simply not statistically savvy or just don't even know what a Monte Carlo is. Is it a relatively good analogy that it's kind of like thinking about taking a deck of cards and shuffling it 1,000 different ways, but except instead of 52 cards, like you said, you start with 5,000 cards. So you can imagine the degree of diversity in terms of passageway, the path differentiation that could happen when you mix everything up.
And I have a graph, or I've got a little dashboard here that like a little test script that I wrote in Python that spits out of Monte Carlo, so I can pull that one up.
I'd love to see it. Yeah, love to see it.
So this is something I built in Python myself, just because I couldn't find this in our Troy time or anything.
We're not seeing it on the chart, so let's make sure that you're hitting the present button and you're hitting it. Let me see if there we go. It's coming up. Okay.
All right, so this is the one for the specific system that we looked at. This for the NDX RSI 1 hour version 1. You see there. So to the top left, you have all the different Monte Carlo combinations. So the dark
5,000 runs, and starts at 0. And what you're looking at is out of the 5,000, the vast majority is net positive when all is said and done. After is it 500 trades? Is it 500?
Yeah, exactly. In this specific one, I did 500 trades.
Right. So, there was 500 trades, and literally, I don't know what is in the percentage terms, but almost 90% of all the various possibilities still made you money. Some of them obviously made you a lot more money. Some of them just barely broke even, but they kind of hung around zero or better for most of these runs, right?
Correct. So that's what you can see there in the table. That's to the bottom right. I'm looking at something called confidence levels.
Okay.
So something that is used in not only finance but in all kinds of science is the 95th percentile.
Right. So the end part. So basically, you're 95% confident that your past results should mirror your future results will mirror your past results because you have so many samples, and the vast majority of various scenarios still show you positive probability, right?
Correct.
So 99% had a net profit of 4,090. So basically, you had a 99% confidence that in the end, you had a 1.7% profit to draw down. You drew down 3,400 and you gained 4,097 at the end. What's the percent decrease? What is that number? The last column, percentage decrease.
So percentage decrease is just a percentage from the default backtest net profit drawdown to the current row. So if you look at
so it's not like you lost, because that looked really scary. I was like, you lost 89%.
No. It's nothing like that. It's just a decrease from between the 11.41 that we see from the default backtest down to the whatever row.
Like, what's the optimal, death test, or what did the test show you? And then like, what's your worst case scenario in terms of, actual performance, but you were still net positive?
I usually look at the 95th percentile. So if I'm above, I'd say an ideal number is above 2 for me to go with it. If I'm still at like 1.5, something like that, I might go with it if everything else looks good. So if parameter sensitivity and all the other tests I do look good, I might still go with it.
Interesting. That's interesting. So this is this any of the strategy? Is this the RSI strategy you showed me? This is the 1 hour?
No, this is the one that we looked at MT5.
Right, the one that we looked at just before, which obviously looks very robust. I mean, it's like, now obviously this has been the most beautiful type of market for this. It's just been, one-way market, right?
Yeah.
Do this in the 1970s market, and you may not get the beautiful idea. So that's another thing I think is a cautionary tale. These are amazingly powerful, very, very useful statistical tools that give you, I think, what you can say, the best thing you can say about them is they give you short-term confidence that at least you're not doing something stupid in the short term, that in the very near term, over the past, like you said, 2,000 bars, about 1,000 days, this has been working. It's proof that this is working because we have statistical evidence that's proving it. And I don't have, if tomorrow everything could change, but as long as today is relatively similar to, like 80% similar to what yesterday was, I'm going to have confidence this thing is going to keep making me money.
Yeah.
Right. Which that's as good as you get, as good as it gets. And I think it's really powerful. What's wonderful about all of this is, of course, to have all this robust type of statistical work. Now, is that something that you share with retail traders? Have you built tools for people, or is this something just internally that you use for yourself? I'm just wondering if, I think you told me you do a little bit of tools and coaching.
Sure.
Could you talk a little bit about how you try to help retail traders bring themselves into a much more sophisticated decision-making process with, the basic tools of science that all scientists use?
Yeah, sure. I mean, my main base is Twitter, or X, as it's called now. So that's where I get most of my.
Can you? What's your X handle so people can follow you?
My X handle is _IO.
Just like it's at _IO or
_IO. Correct.
Got it. Okay, just like
that's what I go by. So that's where I get tons of messages daily. I try to help out as much as I can.
Right.
Some have become like paid customers, you could say, that I help out with coaching, things like that. So I kind of provide like a simple. I teach them like how I code, the type of techniques I use, all the types of the steps I go through in my sequence.
Have you provided any out of the box tools for customers? For people who just want to, like, I have an idea. I'd like to test it in a Monte Carlo. I have a Monte Carlo simulator. Here, we'll plug. So, like, in other words, for people who are not complete geek heads like you and I, just the actual tools to help them run their ideas through it.
Absolutely. I have people approach me with just an idea of a program or a system. Like, I want to do an intraday system that does this and that.
Yeah.
And we might book a video meeting. We talk about it, and I help them develop it. And I can also help them develop tools. I can give them this tool and help them refine. Sometimes people come to me with like a half-finished system. I analyze it, help them refine it, make it more robust, and things like that.
Interesting. Have you found that doing this with people has helped them? Like, do you have customers that you've had maybe for 6 months, a year, that are seeing better results as a result of the fact that they've been more educated in statistical analysis?
Yeah, I mean, first when people came to me, they had extremely overfit systems. if I generalize, complicated overfit systems with a lot of filters that didn't make sense. A lot of them didn't do walk forward testing, in sample, out of sample.
A lot of them did not do that.
Yeah, they did not do that. No.
Right. So again, to sort of explain to people what is a walk forward optimization, or just walk forward testing, is basically you have like all this past history. It looks great, right? And you throw all that out and you say, let's test this actually on the future or fake future. Can you maybe explain much better than I can, what are some of the techniques of walk forward optimization that people like to use? Because obviously we don't have, future takes a long time to happen.
Sure.
So people like to, they'll take sort of what they call out of sample data, which means, let's say you tested it in, 2022 to 2022. You say, okay, great. Let me test this on 2018 to 2020 and see if this has any legitimacy at that time frame, right? Something like that.
Sure. Yeah. So usually with walk forward, how I do it is I set a ratio of in sample to out of sample. So a lot of people use 70 to 30. I usually go, depending on what system, but 50-50. I've been going with a lot.
Is there a reason why you like to use 50-50? Because you think it's a little more robust as far as, validating the data? Because probably so much data gets completely invalidated once you take it out of sample.
Yeah, that's exactly the point. So I really want to have as much out of sample as I can. I think under 50, it gets really difficult to get something useful out of it.
Right. Interesting.
So I'm looking at 50% of data is known to the system, and it try to look at that and try to optimize the parameters. And then you just take that and apply it to the other half that we haven't seen yet. So let's say I do a 50-50 now on the last 4 years. So I'll be looking at 21 and 22 would be in sample. So you would take the algorithm, ask it to optimize the parameters according to what the market looks like in 21 and 22.
Right.
And then they would apply that model that it found to 23, 24 to see what the theoretical gain would be there too.
Right. And do that. So that's fascinating. And obviously that probably eliminates a lot of ideas that people have. You probably break more hearts than Miss America in terms of in terms of people's hopes for analytics. But the other thing that you told me you do that's sort of fascinating is just in looking at your whole portfolio, you say you'll just throw some parameters out, like you'll random removal to see, hey, it's basically sort of a stress testing methodology. It's like, let's see if this car can travel on 3 wheels versus 4 wheels, kind of a thing. And let's see how long it can go on being hobbled. So can you talk a little bit about that? Like maybe some examples of what you've done?
Yeah, sure. I can show you some graphs too that I drew up or that I extracted. So what I did is exactly what you said. I'm removing a parameter in my code or change it altogether just to get, in some sorts, it's kind of like a Monte Carlo of the parameters. I want to see that how near.
Yeah, it's interesting. Yeah.
So kind of like near, what would we call it? Like parameter combinations that lie near to what I'm using, and I want to see kind of plot them up and what would it look like if I just tweaked them a little bit in the wrong way. And that's kind of to simulate, if the markets would turn or become choppy or, go from bull to bear.
Right.
So we can start.
And also kind of like a backhanded way to say, hey, did I really over optimize this thing? Like, I saw something, in the past, it looked really, really great. And I'm like, oh, I'm absolutely convinced that this is the way forward.
Yeah.
And it's a way to sabotage your own beliefs, or to put it more professionally, to question your own beliefs in a more, egalitarian manner. So when you said you wanted to show me a little bit.
Sure.
Yeah.
So we can start by look at like a parameter sensitivity topography that I usually do for everything. So here I've plotted up the combination on two variables. So let's say we would look at the RSI strategy that we just looked at.
Okay.
Then I might optimize for both the RSI numbers. So the buy signal number at 65 and then the sell at 85. So I might set, let's say I do the whole spectrum. Let's say I do 5 to 100 just for fun, just to see what happens.
Okay.
So with this specific system, we end up here, right here up on that plateau. And that's kind of what I want to see in a system, because that gives me confidence that if the markets start to slip, that if I start to slide around on this plateau, I'm still going to be pretty good.
Okay.
I'm still in a good combination.
So to understand what this plateau is visually showing us, you're changing these parameters. These parameters are essentially 65, 85.
Yeah.
But you're saying, no, I'm gonna use anything from 5 to 100 as my entry parameters and see what the results would be.
Yeah.
And this is showing you that a large part of the results are still up on that mountain. They're not. You haven't come crashing down, right? There isn't that cliff. You haven't fallen off the cliff, right?
Exactly. And so the Z direction, this one is gain. So the greener it is, the higher it is, the more gain it is.
I see. Okay.
So obviously,
and that brown area that looks like that looks like the cliffs of the Palisades river. What is that showing you? That's showing you that, like, if you use those parameters, you'd just be bleeding money, or
you'd just be bleeding money.
Okay.
In that case. So what I like to look at is I look at this point and I might like plot up, let's say like a square, 10 to 20% surrounding parameters. Just to see that what would that slippage, how would my equity curve change with that slippage? Right. So with a slippage, I'm meaning like a market change. So I can pull that up too. One that I just plotted today. Okay. So this is the one. So
what is the default? The 150 out of 200. Is that is this moving averages, or like what is
this specific one is for moving averages, because
the default is the 5200, and then if you started changing them around, what the results would be, right?
Correct. Yeah.
The real big losses happen when the parameters really go far away from the originals, like 160, 800, where they're just completely crazy.
Correct.
So what you're saying is, look, as long as I stay within a 10-20% band of the original values, I'm not going to get too badly hurt.
Yeah, that's essentially what it is. So if the larger I can plot that area, so it'll be good, the more confidence I had in it that it will withstand all kinds of market changes.
Interesting. So is that also a Python script tool that you help people, you let people plug in?
Correct. So it extracts all the combinations.
I like the cliff one was really, really cool. The cliff, I must say, the cliff one.
Yeah, I got a second one that I can show you with a system that I had that I was working on the other day, just to show you like a little bit more 3D what it might look like.
Right.
So this is from an optimization I did a couple of days ago, and it gives me this one.
Okay.
And you can see it chooses a spot that's right on the tip right there.
Right. That's the optimal spot, right?
Really close to the tip, and I'm not going to go with that one just because it might give me the nicest results, the biggest gain and everything, but it's a tiny change in the market. It's going to cost me.
Are you just falling off a cliff? This looks like a suicide dive.
Yes. And this is a thing that people kind of disregard a lot. You develop a system, you optimize your system, and it spits out like the perfect parameters for your system.
Right.
And it's like everything is great. But it might fail within a month. People don't understand why. And then you look at the parameter sensitivity and you see that it's right there on a spike.
Right.
And they've fallen off the cliff. So if I get this this result, I'd rather place myself in the middle here somewhere.
Right.
It might, yield a gain that's not as good, but at
Right.
least I'm stable or more stable.
Yeah. And that's the key thing, stability. So that's actually, brings me up to the last question I have for you, which is really the question about emotion. We've done quite a lot of, analysis, science, reason. But in the end of it, it's stability that I think really matters, because emotional instability, which is caused by financial instability, sometimes will, of course, drive you to forget all of your analysis, because ultimately, everything rests on faith, right? The irony of the whole thing, all of science actually rests on faith, and essentially faith in the scientific method, faith in the statistics, faith in the actual statistical models that we use. And of course, they all can be turned around, like we know. So is that the key thing that you're looking for? You're looking for financial stability, which hopefully gives you emotional stability to continue with the strategies, even when you're when they're really testing your soul. Is that
I mean, that's good. That's a good analysis. I mean, people like to refer algorithmic trading as emotionless trading, and I wouldn't say it's less emotion, but it's not emotionless.
Yeah, it's only less emotion in a sense that you're not executing the trades, but you are reacting to those trades.
Exactly.
If your algo is bleeding, it's doing 3, 4. And the thing about algos is they don't care. They'll go 5 losing trades in a row. They'll go 6. They're programmed to go. They're gonna run into bullets. They're never gonna like us. Oh my God, I'm hurt. I'm gonna sit there in a corner and not take this next trade because I had 5 losers. They're just gonna go straight up and do another one, do another one, do another one. And of course, lots of history of algorithmic trading is littered with algorithms just gone wrong. I mean, everybody remembers there was a high frequency farms. Forgot the name of them. That simply their algo was not updated. The guy just simply forgot to update one little kernel, and the thing just sold 400 million times at the market open. Literally blew up all of their equity in one day because it was because it just kept doing it. That's the beauty of computers. They'll keep doing it for the good, for the bad. And we, of course, are reacting to what they're doing. So it doesn't matter. Yes, they're executing our trades emotionlessly, but we're emotionally reacting to that. So I think that's so it's interesting that I like your approach. Your approach is really not about winning optimally. It's about actually trading optimally, which is emotionally stable as possible. Now, having said that, kind of last question: what's been the biggest drawdown? What's been the biggest market challenge to you in terms of your strategies? Like when have you had like 20%, 30% drawdowns, larger drawdowns? And when that's happened, how did you react? What did you do? I'm just curious.
Yeah, I mean, certainly in the beginning, I had larger drawdowns. It took me probably a couple of years before I started to get the hang of it and like really got all the systems that I wanted to, to have a diversified portfolio. In the beginning, I was running, maybe 2 or 3 NASDAQ systems that were very, very much correlated. In hindsight, very overfit. And so, I've had 30, 40% probably drawdown. And just had to accept that. It was just learning money. It was not a big stake because I was starting out. So it's not a lot of money. But I was in the beginning, I was devastated. I'm like, am I ever going to get this to work? But then I started to take these measures for robustness from Monte Carlo, started looking into portfolio optimization rather than algo optimization, because that's what I did in the beginning. You'd optimize an algo and you find something like, oh, it's making 200% a year. That's reasonable. But it's not. Like a reasonable algo might be, 30% a year, but you have a lot of them instead.
Right. Exactly. So how is it working these days? Where how much drawdown can you absorb with equanimity, like without really, getting upset? How the system's been doing since you've tried to balance them out as much as possible?
Yeah, for me, I'd say probably 20 to 30. If it's really stable systems that I know what the Monte Carlo looks like and it's within that Monte Carlo range, I'm just going to be like, it's statistically possible that it's going to do this. and I'm not giving up on this, and I'm just trying to chill out. It gets easier and easier. It wasn't easy in the beginning,
Yeah.
but now it does, because you see those algos work their way out of the drawdown, and
Right.
you gain more and more confidence now.
Right. Yeah, you do. Now, as far as portfolio itself, at what level do you like, I'm having a hard time breathing at night because, we're bleeding so much money. Like, where has portfolio been on the worst case scenarios over the last year and a half, after you've had it sort of really got much better control over the process?
So during the last year and a half, I'll probably be down 20%. I'd say. But
I mean, that's a lot, but it's completely absorbable. I think psychologically people can lose a fifth of their equity. Then it's not pleasant, but they'll stay with the strategy. I think when they get to 40%, that is when they question themselves. And when they get to 60%, they become suicidal. That's sort of been my that's been my experience with drawdown issues. And that's, would you say that's sort of relatively accurate? Like if you can be 20% down, but then at the end of the year and what do you look for? Like what's a good year for you? Like where you're happy? Because again, you're not looking to optimize, you're looking to stabilize.
So a good year for me, I would say between 50 to 100%.
Wow, that's huge. I mean, that is really huge.
It's been going quite well, especially this year with a lot of trending algos. Of course, have been overweight, and I'm right about 100% for the year.
Now, let me ask you this: 25 is coming.
Yeah.
Are you gonna Elon Musk it and just double up, go all in like he does on every single bet in his life, or
No.
are you gonna say, okay, I had a great year, I'm 100% up, I'm gonna take half that profit, put it into treasury bills, and run the rest? Sort of, because the probability of me hitting 2 consecutive really, really strong years is, through any Monte Carlo, through a human Monte Carlo simulation, when relatively minimal. Or I don't want to put words in your mouth. I'm trying to. What's your thought pattern for 2025?
Yeah, no, I mean, I'm quite conservative and pragmatic by nature, as I've noticed many physicists and engineers tend to be.
Right.
And I actually discussed with another algo trader just last week about a new a T-bond kind of system. So I'm definitely rotating some of those.
So there you go. You're going into yield, my friend.
Yeah, I am.
Correctly.
And I'm not. Yeah. It's all about conserving portfolio, keeping that balance.
Right.
So I'm not going to double up. I'm going to try to analyze the market as good as I can, and take a defensive stance.
Wonderful. Well, it's been a real pleasure. It's really eye-opening. So many interesting ideas that you constantly do. Please tell everybody. Obviously they can find you on Twitter, on X at square2 _IO. Is there any other way they can reach out to you if they want to talk to you? And it's the process generally, if they want to work with you, they need to reach out to you, have an initial sort of a prospective call, and then you can do some coaching with them. Is that how it works with you?
That's usually how it works. Yeah. So you can reach me on Twitter, or you can email me at hello@square2.io.
All right. Wonderful. Well, Oscar, it's been nothing but pleasure. Thank you so much for sharing so much interesting and so much sophisticated information with all of our retail traders. You definitely left a lot of food for thought here. And, we wish you the best of luck. We hope you have another 100% year, even if you're going into treasury bills.
All right. Thank you so much.
Thank you so much. And for everybody else, be sure to follow us. Be sure to click the subscribe button on the Trading Battle channel, because this kind of content is coming your way all the way next year. And as always, I'm Boris Schlossberg. I'll see you guys in the markets.